Artificial intelligence is everywhere right now, from chatbots to deepfakes and strange videos to composing music, and even in technology like self-driving cars. Investors are pouring billions of dollars into AI startups, and public companies betting that the next big breakthrough here will change the world are expected to invest trillions in the AI build-out over the next few years. But with any big innovation, there is always the same concern, and that is getting ahead of oneself. New AI video generation software like Sora AI is able to make videos nearly indistinguishable from reality. But is this actually valuable to us? On the more practical side, AI has become very effective at managing tasks ranging from coding to customer service and more, and supposedly, a lot of commonly held jobs today are at risk. But from a financial standpoint, the biggest question that's beginning to emerge here is whether or not AI spending is creating a massive bubble. In today's video, we're going to explore what's going on here, where investors are putting their money, and more importantly, how you can protect yourself and your identity in this AI future. I think the best way to predict the future here is by looking at the past, and that's exactly what we're going to do because, as you know, history repeats itself. So we're going to be looking at some historical bubbles in tech and finance to see if we can spot any patterns here that hint at what might happen next. Before we dive in, if you guys enjoy this current event style of content, do me a favor and drop a like on this video. The first thing I want to cover here is what's going on today in the worlds of AI, big tech, and everything in between. In a nutshell, big companies are pouring a staggering amount of money into artificial intelligence infrastructure. But just how much money is being spent here? Well, according to Morgan Stanley, capital expenditures on AI infrastructure could exceed $3 trillion over the next 3 years. But is AI actually going to change the way that we live and work forever? Here's a scary truth. A study by MIT found that 95% of generative AI pilots at companies are failing, meaning that they are not in fact changing the way that we do business most of the time. So whether or not we asked for it and whether or not it actually works, the billionaires are plowing ahead in this ultimate moment of trust me, bro. But beyond just the massive sums of money being spent, a major concern arising is where that money is being spent today. And this is creating what some analysts are calling a circular investment loop. For example, chip maker Nvidia is planning on investing up to $100 billion in OpenAI, but this is not your typical investment. Because the terms of this deal reveal that Nvidia is going to be paying this out in installments based on essentially how many of their chips are being brought online. Guys, that would be like having a lemonade stand, only your lemon supplier is your biggest customer. So your lemon supplier invests in your lemonade stand, but only invests a certain amount based on how many lemons that you buy. And get this, they're going to be buying the lemonade too. That kind of self-reinforcing financing raises warning flags. Are companies funding each other to create artificial demand versus building independent value? And it's not just OpenAI and Nvidia. This chart here, sourced from Bloomberg, has now gone viral all over the internet, showing the complicated web of circular deals in the AI industry. Are we in the next speculative bubble? A speculative bubble describes a situation where asset prices rapidly climb far beyond their intrinsic value, often driven by speculation, excitement, and the belief that someone else will pay more later. In other words, it's when investors are buying something not because the fundamentals are strong, but more because they expect to resell at a higher price later. So let's compare today's AI investment surge to some of these speculative bubbles of the past. The late 1990s internet boom, also called the dot-com bubble, is the most obvious parallel because there was massive capital investment poured into internet firms with little proof of viability. As a result, valuations soared, and this led to tons of people chasing the action in the stock market. Similarly, the housing market boom prior to 2008 was driven by rising prices detached from the underlying fundamentals. Today's AI wave not only echoes two of these bubbles from the past, but it even involves some of the same characters. Enter Michael Burry, the big short investor who successfully predicted the housing market crash, bet against it, and generated once-in-a-lifetime returns for his investors. Well, he's back at it again, because on November 4th, Burry announced his next big short, betting against Palantir, and you guessed it, Nvidia. And here's what Palantir CEO Alex Karp had to say about this.
The people who piled in to Palantir were people investing their own money. The experts sit on the sideline and say, hey, this can't be true.
Most analysts, think that this stock is overpriced. You have people like Michael Burry out there shorting it.
It just is super triggering because these people, they could pick on any company in the world.
But what are the warning signs that a bubble might be forming? Before we get to that, I want to talk about how to protect yourself from the dangers associated with this AI wave. Here's the thing, these aren't your typical sketchy emails anymore. Scammers are using AI to create realistic websites, clone voices, and even make fake endorsements that look totally legit. That's exactly why I'm excited to tell you about NordProtect, today's video sponsor. They're an all-in-one identity protection service that's got you covered from every angle. With 24/7 dark web monitoring, NordProtect scans your email, phone number, and social security number and alerts you instantly if your information shows up where it shouldn't be. In addition, their credit and identity monitoring lets you know right away if someone opens up a loan or account in your name, and their identity restoration team can step in with up to $1 million in coverage to help recover lost wages and other expenses. You're even protected against online fraud, a variety of scams, and cyber extortion, with reimbursements of up to $50,000 if scammers target you. NordProtect has got your back 24/7. That way you can focus on building real wealth instead of worrying about AI scammers draining your bank account. So protect your identity right now, take advantage of the exclusive discount and the 30-day money-back guarantee by visiting nordprotect.com/Ryan Scribner. The first warning sign, and arguably the biggest, is when valuations are detached from profits, wherein companies are rising fast without corresponding earnings growth. One of the best indicators of this is called the price-to-earnings ratio, and this demonstrates what investors are willing to pay relative to that company's ability to generate $1 in annual profit. To establish a baseline here, the S&P 500 has an average price-to-earnings ratio of roughly 30 right now. So on average, investors are willing to pay about $30 for every $1 in profit that these companies can generate annually. But what about Palantir and Nvidia? Nvidia has a price-to-earnings ratio of just under 54 as of writing this script, and as far as Palantir goes, that's coming in at, wait for it, 217. Now that number alone does not indicate that Palantir is far more overvalued than Nvidia, although it is possible. And that's because the price-to-earnings ratio does not factor in earnings growth. Because here's the thing, if a company is able to rapidly grow their earnings, they can potentially justify a high valuation later on. But on the other hand, if earnings don't grow as expected, the stock could drop sharply. So that, of course, begs the question, is this circular deal making that we are seeing really about what's best for the industry, or is it more about boosting corporate earnings? The final warning sign of a speculative bubble that I want to cover is concentration risk. And this is when a small number of firms dominate, leaving the entire market dependent on their performance. So guys, here's my take on this whole situation. I don't personally own any AI stocks, but if I did, I would be taking profits right now because I feel that the risks far outweigh the potential reward. And as far as the MIT study goes, I think that the benefits associated with AI are going to be largely industry specific. And let me give you an example. Artificial intelligence has provided some massive benefits to my content business, primarily through the lens of translations and dubbing. Back in January, I launched a Spanish version of my YouTube channel, fully AI, and since then, my team and I have launched about 20 additional languages. As far as results go, last month, this international segment of my business received 13.5% of the watch hours as my main English channel. So to say that AI will have no benefits is incorrect, but it's also incorrect to assume it's going to have the same effect across all businesses. I think some will benefit massively, a bigger group will experience some benefit, and the largest group of all is going to receive no benefit from AI. But that, of course, is just my opinion, as a lot of this is. And I would love to hear what your opinion is on this AI situation in the comments below. While you're down there, don't forget to check out NordProtect, linked in the description below, or by visiting nordprotect.com/Ryan Scribner, because protecting your identity is going to be more and more challenging as AI becomes more powerful and mainstream.